Today, we are going to crack open a document that, in business terms, feels like it's from another millennium, a shareholder letter from over 40 years ago. But trust me, this isn't some dusty history lesson. This is Warren Buffett's 1981 letter to Berkshire Hathaway shareholders. And believe me, it is packed with some of the most powerful and timeless business ideas you will ever come across. So let's get right into it.
So back in 1981, Berkshire Hathaway's operating earnings hit 15.2% of their beginning equity. Now, by any measure, that is a really solid number. It's the kind of big, headline figure that makes investors feel warm and fuzzy. But of course, with Buffett, he immediately wants you to look past the obvious. He asks this simple but kind of profound question. What if the real story, the true measure of the company's value, is actually invisible to standard accounting? And this is where we get our first huge lesson from Buffett, the massive difference between accounting and cold, hard reality.
So Buffett introduces this idea that really forces you to see a business differently, not as just a bunch of entries on a ledger, but as a real claim on future economic output. It's all about learning to see the value that just doesn't show up on the income statement.
He calls it non-controlled ownership earnings. Okay, so what does that mean? In simple terms, it's Berkshire's slice of the profits from companies they'd invested in, like Geico or the Washington Post. Profits those companies earned, but didn't actually pay out to Berkshire as dividends. Now, regular accounting, it just ignores this money completely. But Buffett's argument is that this value is absolutely real, and sooner or later it will benefit Berkshire shareholders, whether it shows up on the books right away or not.
And the sheer scale of what was being missed is just staggering. In 1981, Berkshire's reported earnings were about $40 million. But their share of the unreported earnings, just from 4 of their investments, was over $35 million. Think about that. The value you couldn't see was almost as big as the value you could. That gives you a massive insight into how Buffett was really thinking about his company.
And this quote just nails the whole philosophy. See, for him, it's not about control or building some massive empire. It's all about getting the most economic bang for your buck, even if that means owning just a small piece of a truly fantastic business. And this whole idea, valuing smart ownership over total control, leads us right into his famous critique of corporate takeovers.
To explain why so many corporate acquisitions go wrong, Buffett tells this little fairy tale. He frames the typical CEO mindset as a story, one where managers really believe they have some kind of magical touch.
And he lays out this really sharp contrast. On one side, you have Berkshire, patiently buying pieces of great businesses on the stock market at reasonable prices. On the other side, you have the typical corporation that gets all excited and pays a massive premium. We're talking often double the market price to buy an entire and often pretty mediocre company.
Which leads to the big question, right? Why on earth would they do this? It seems totally rational. Why would a manager pay $2 for something their own shareholders could just go out and buy for $1 on the open market? Well, Buffett says there are 3 unspoken reasons.
First, animal spirits. The simple thrill of the deal, the excitement of the hunt. Second, managers are judged, and more importantly, they're paid based on the size of their empire. As Buffett points out, a Fortune 500 CEO almost never ranks their company by profitability, it's always by sales. And third, you've got the fairy tale delusion itself.
And this is where he delivers the punchline. The acquiring CEO, that's the princess. The company they're buying, that's the toad. And they truly believe their managerial kiss is going to magically transform this toad into a handsome prince of profitability. But Buffett, he's deeply skeptical. He says he's seen a whole lot of kisses, but very, very few miracles. And the end result of all this? A corporate landscape that he describes as being knee-deep in unresponsive toads. I mean, what a perfect image, right? It just captures the outcome of paying way too much for an average business, all because you hope you can magically fix it. Okay, now let's zoom out. We're going from the decisions inside one company to the wider economic game everybody was playing back in 1981. Because back then, the rules of that game had totally, fundamentally changed.
You see, for decades, the math was super simple. The average American business earned about 11% on its equity, while a super safe government bond would get you maybe 5%. Owning businesses was a complete no-brainer. But by 1981, that whole world was flipped on its head. Corporate returns were up to around 14%, but because of a fierce battle with inflation, bond yields had skyrocketed to 16%. All of a sudden, taking zero risk paid you more than taking on business risk.
And this is where Buffett brings in another brilliant analogy, the crossbar. Think of it like a high jump competition. The return you can get from a totally passive investment, like a bond, sets the height of the bar.
and any other investment has to clear that bar to even be considered a success. By 1981, that bar had been raised to an incredible, almost impossible height.
And what this leads to is, well, it's a pretty painful conclusion. It didn't matter if companies were actually performing pretty well, because the crossbar was so high, most of them were no longer creating any real value for their owners compared to just buying a bond. In purely economic terms, they had become bad businesses.
And if that high crossbar wasn't bad enough, there was another destructive force out there making things even harder, and that was inflation. And Buffett's metaphor for it is, wow, it's really visceral.
A corporate tapeworm. It's a disgusting image, I know, but it is perfect. This tapeworm lives inside the business, and it secretly eats all the resources before the owners can get any nourishment at all.
So here's how this tapeworm works. A company reports a profit on paper, but just to sell the same number of widgets next year, it has to spend way more on raw materials and inventory because everything costs more due to inflation. That tapeworm effectively eats all the cash that was generated by the so-called profit. The business is just running harder and harder to stay in the exact same place, and the owners get nothing. The plate is clean.
But here's the really cruel twist with this tapeworm. Any rational person would take their money out of a low-return investment, right? But inflation forces these bad businesses to reinvest every single penny they earn, not for growth, but just to survive. It literally traps good money in a bad business, destroying capital year after year. Okay, so after all these stories, these parables of invisible earnings, fairy tale kisses, high crossbars, and these corporate tapeworms, what's the takeaway? Let's just boil it all down into a few core principles that are just as powerful today as they were back in 1981.
First, you have to look past the accounting numbers to find the true economic reality. Second, focus on value, not control. Owning a piece of a truly wonderful business is way better than owning 100% of just a fair one. Third, always be skeptical of miracle cures in business. Toads very rarely turn into princes. And finally, always measure any investment against the simple, passive alternative. That is the bar you have to beat.
And that, of course, brings us to right now. These mental models from 1981 are tools you can use today. So the question for all of us is, with today's interest rates and today's inflation, just how high is that crossbar? And maybe more importantly, which of today's companies are secretly feeding a tapeworm, turning their reported profits into nothing more than an economic illusion?